What an interesting time. On the one hand, GDP contracted for the second consecutive quarter, indicating that the economy may be going into a recession. On another hand, July was the best month for the stock market since 2020. On one hand, the mortgage interest rates are about 2% higher than at the beginning of the year. On another hand, mortgage interest rates retreated by about 0.5% from the peak of mid-June. On the one hand, the inflation reached 40-year high levels. On another hand, the gas prices are starting to go down. Combination of these forces created a significant housing market slowdown here in the Bay Area. This is Michael Talis with the Talis team. In this video, I am going to talk about what this market change means in practical terms for the buyers and sellers who are currently on the market or just thinking about it. Please hit the like button, subscribe to this channel, and let me know what you think in the comment section below. The most glaring sign of the housing market shift is the number of sales. In July, the number of sales dropped by 44% compared to the same time of last year, and by 24% compared to June. It was the lowest number of homes changing hands since January of 2021, and Januaries are not known for high activity levels. Keep in mind that most of the July sales were negotiated in June, when mortgage interest rates soared above 6%. In July, median time on the market increased to 13 days, the slowest pace of sales since January of 2020. As the result, the number of homes available for sale in Santa Clara and San Mateo counties grew to over 3,000 units, a 26% increase year over year. An indicator of the future direction of the housing market is the number of new contracts. It dropped by 38% year over year. Month-over-month drop was not as significant, only 8%. It is hard to say if this market slowdown is a new normal or just an annual seasonal trend. A perfect storm combining economic headwinds with the summer vacation season may have created an unusually deep dip of the market activity. But there are reasons to be optimistic. The market may rebound after the Labor Day. Over the last 6 weeks, the interest rate declined by about 0.5% and should stabilize in that range. According to Chief Economist of the National Association of Realtors, Lawrence Yoon, most of the mortgage rate changes have already occurred. Now it's going to be bouncing along, a little up, a little down. Also, since mid-June, all major stock market indices were on an upward trajectory, reversing the earlier trend. Both of these factors should boost buyers' confidence, help to secure down payments, and make mortgages more affordable. If you're a seller, don't hesitate to put your house up for sale. The prices are still at historically high levels. The median home sale price, 2022 year to date, is up by 10.6% compared to last year. And if you're a buyer, it is the best time to shop for a home since spring-summer of 2020. There are significantly more homes available for sale, and there is less competition from other buyers. If you are planning to own your new home for 5, 7, 10 or more years, you should not hesitate to enter the market. This is Michael Talis with the Talis team. If you are thinking about exploring your home buying opportunities or home selling options in this challenging housing market, call or text me at 650-766-6100. I'm looking forward to connecting with you. Till next time.